Welcome to the debate. Today we are tackling what is, I think, the most pressing and frankly terrifying question facing digital assets. The recent, really dramatic plunge in the cryptocurrency market. Bitcoin has fallen sharply, dipping below that $86,000 mark, and the total market cap has lost a staggering $1.2 trillion since just early October.
And that scale of loss, I mean, in such a short amount of time, it demands we look beyond the superficial explanations. We really need to understand if this is just a garden variety bear market or something more like a structural failure.
Precisely. And our central disagreement today really rests on defining the dominant driver of this financial destruction. Is the current decline mostly a consequence of these powerful external macroeconomic pressures? I'm talking specifically about Federal Reserve policy, the tightening of global liquidity, and Bitcoin's, established correlation with traditional risky assets.
Or, and this is my core position here, is the catastrophic scale of the market's retreat fundamentally driven by internal structural vulnerabilities that have been, allowed to fester inside the crypto ecosystem? I'm talking about things like excessive leverage and dangerously low liquidity.
And I'm going to maintain that the fall is primarily dictated by those macro events. Bitcoin is behaving exactly as a highly speculative asset does when the tide of cheap money finally goes out.
And I'm going to argue that the trigger might be external, sure, but the bomb that actually exploded, the one that wiped out $1.2 trillion, was built, timed, and armed internally through systemic fragility and the self-inflicted wounds of these cascade liquidations.
Okay, so let me begin by laying out the case for macroeconomic contagion. The price action we've seen over the last few months confirms in no uncertain terms that BTC is functioning as a high-risk speculative investment, and it's completely tethered to global liquidity and interest rate expectations. It has, definitively failed the digital gold test. The evidence for this is clear. We've seen the 30-day correlation between Bitcoin and the NASDAQ 100 hit 0.80. That is essentially a full coupling with the most speculative part of the traditional tech sector, and it's a 3-year high. This relationship tells us exactly where the market sees Bitcoin, not as some inflation hedge or a new store of value, but as a marginal high-beta tech stock.
Yeah, that 0.8 correlation is, I'll admit, a very powerful piece of evidence. It shows just how closely tied the asset class has become to risk sentiment in general.
And then look at the opposite correlation. Bitcoin's relationship with physical gold has dropped to almost to zero. When interest rate expectations change, money moves. The immediate trigger for the most recent volatility, that dramatic push below 86,000, was the stronger than expected U.S. employment data. That data signaled the economy was just too robust for the Fed to consider a quick rate cut in December. And when the prospect of cheap, abundant capital goes away, the first assets investors shed are always the most speculative and unregulated ones. Fundamentally, the root cause of the initial bubble was the unprecedented expansion of central bank balance sheets, particularly the Fed's, which inflated to over $9 trillion by 2024. That fire hose of excess liquidity had to go somewhere, and it went into high-risk, unregulated markets like crypto.
I'd agree that the macro environment created the fuel, all that cheap liquidity, but the market's internal structure provided the accelerant. I come at this from the perspective that the sheer magnitude of a $1.2 trillion drop, it just cannot be explained solely by a rate hike delay or slightly better employment numbers. It exposes these deep, chronic, structural flaws. Consider what analysts are calling bearish asymmetry, or the pain gap. The observation is that Bitcoin falls much, much more severely when the stock market is down or macro fears flare up, but it participates, pretty insignificantly in the upward movements when risk appetite returns. If it were just a high-beta NASDAQ play, that asymmetry shouldn't be so profound. That's a huge red flag. It's a telltale sign of a structurally unstable market that can handle small inflows, but just collapses under any kind of significant outflow.
You're focusing on the market's reaction, but I'd argue that reaction is actually proportionate to its perceived risk level during a macro contraction.
No, I'm focusing on the internal amplification mechanism. External shocks, whether it's the announcement of U.S. tariffs on China back in October or concerns about sovereign debt, they're magnified into these catastrophic events by massive internal cascade liquidations. We can't just gloss over the Black Saturday or 10/10 event. Over $19 billion in leveraged positions were liquidated in a single night. What that means in practical terms is that margin calls were triggered, forcing the automated sale of assets at any price, which then drives the price even lower, which triggers more margin calls. The scale of that forced selling, it demonstrates that the internal market structure, not just general risk sentiment, is the defining factor of the crash's severity. And this fragility is made even worse by this persistently low structural market liquidity, including stagnating stablecoin supply and the failure of order book depth to recover.
That just means those $19 billion in forced sales hit a very shallow pool and sent shockwaves far deeper than they ever should have.
You've laid out a very strong case for structural weakness, I get that, but let's go back to the directional signal. If the market is coupled at 0.8 with the NASDAQ, the direction is being set externally. BTC is a derivative of global risk sentiment. When money leaves the highest risk assets, it retreats to safer, established assets, like mega-cap tech stocks, leaving crypto as this marginal asset that just gets disproportionately dumped. The severity, which you correctly identify, is a feature of its marginal high-risk status, but the fundamental cause of the downturn is the macroeconomic environment.
I accept that the macroeconomic environment provides the trigger, but I challenge the idea that the severity is simply a feature of its marginal status. It's a feature of its endemic overleveraging. Why does crypto catch pneumonia every single time the NASDAQ sneezes? It's because the internal structure encourages traders to, go too far over and over again. The system is just engineered to maximize speculation through high-yield protocols and easy credit, creating this massive base layer of unstable debt. So when geopolitical news like the threat of tariffs or even minor changes in rate outlooks hit, they don't just cause normal selling. They instantly trigger panic and forced liquidations. That mechanical failure, the forced deleveraging, makes the internal structure the determinant of the crash size. It is the internal mechanism turning a 5% external downturn into a 30% internal collapse.
And this internal fragility is, I think, best exemplified when we look at the systemic risk that comes from centralized entities. I'm thinking of, the disastrous collapse of platforms like Celsius Network. They filed for bankruptcy with a $1.2 billion deficit, owing users $4.7 billion. This was a centralized platform using a decentralized asset, and its failure really revealed the danger of the whole underlying business model. We even have testimony that Prime Trust, their former counterparty, warned that Celsius's strategy of endless rehypothecation of assets was, and I'm quoting here, doomed to failure during sharp market movements. For anyone listening, rehypothecation means taking a user's deposited asset, loaning it out, and then using the collateral from that loan to take out another loan, effectively using the same capital multiple times over.
This inherently fragile structure creates systemic risk that operates completely separate from Fed policy. This is a fundamental internal design vulnerability baked right into the system.
I fully acknowledge the catastrophe of Celsius and the internal ethical failings of those platforms. This system lacked transparency, it lacked accountability, and that led to massive user losses. And this is the crucial distinction, we have to ask why these highly leveraged, often reckless, centralized platforms got billions of dollars in assets under management in the first place. The answer is external. It was the unprecedented influx of cheap speculative capital provided by global quantitative easing. This external monetary environment created a scarcity of yield in traditional markets, which forced investors to chase these exorbitant yields offered by unregulated high-risk ventures like Celsius. QE incentivized the reckless behavior. The $1.2 trillion market loss we are currently debating is a broad, market-wide phenomenon. It's a generalized flight from risk across the entire asset class, not just an isolated failure of a few bad actors. The systemic scale of it points directly to generalized macroeconomic fear as the primary vector. Let's talk more about that negative asymmetry, the market's inability to participate strongly in upside rallies. If the microstructure were robust, as you seem to be suggesting, the lack of upward momentum when the NASDAQ is bullish, well, it shouldn't be so pronounced. This asymmetry confirms my view.
Investors see BTC as a secondary speculative asset that they prioritize selling when risk aversion sets in, and they are hesitant to pour capital back in quickly. If crypto's fundamentals, decentralization, censorship resistance, if they were robust enough to function as a genuine alternative, it would act as a hedge. But the near-zero correlation with gold proves it fails this hedging function entirely.
I'm just not convinced that the lack of upward participation is simply a matter of investor prioritization. That negative asymmetry is a direct, quantifiable consequence of these microstructural deficiencies, and I want to highlight the role of liquidity here. Low structural liquidity is the critical internal element that reinforces the asymmetry and makes any recovery extremely difficult. And when I talk about low liquidity, I mean two specific issues. First, the stagnation in stablecoin issuance. Stablecoins are the primary ammunition for market makers and traders. So if the supply of stablecoins isn't growing, the capacity of the market to absorb selling pressure or facilitate large trades, it just diminishes. And second, the order book depth, the volume of buy and sell orders ready to be executed. It has not recovered to its 2024 peak levels. This thin market depth is critical. It means that large sell-offs by whales, who control an estimated 95% of the BTC supply and just 2% of wallets, they become disproportionately effective. A few large entities can drive the price down severely with relatively small capital, which indicates that market fragility and potential manipulation, which are internal dynamics, are far more relevant than a simple macro correlation. The system is just brittle and easily dominated by large players. So let's circle back to leverage as the enduring internal problem. It's not just a symptom, it's a cyclical, recurring structural flaw that really defines this market. We have specific, granular examples of how internal leverage causes disproportionate damage. I mean, look at the liquidation of a single major trader known as Aguila Trades, who was liquidated for $83.56 million in ETH after a relatively small price movement. That single forced sale sent ripples throughout the derivative markets. Excessive speculative leverage is a continuous source of market instability, regardless of whether the Fed raises rates by 25 or 50 basis points. The inherent design of decentralized lending protocols, combined with centralized exchanges offering high margin, just encourages this fragile house of cards. And when the wind blows, that house collapses, and the scale of the collapse is entirely self-determined.
I understand the pain points caused by leverage. I do, but I believe you're still confusing cause and effect. I would argue that the high leverage is actually a necessity that's imposed by the asset's own volatility. The extreme volatility of the market itself, BTC fluctuating 50 to 70% in short periods, that's what compels traders to use such high leverage just to achieve meaningful returns in this environment. The asset class is fundamentally unstable because it lacks intrinsic predictable value, and it relies on speculative dynamics, and those speculative dynamics are fundamentally driven by the ebb and flow of global liquidity. When that liquidity contracts, volatility increases, margins tighten, and the overly leveraged are simply the first and most painful casualties in a broader, necessary macro correction. You can regulate leverage all you want, but if the core asset lacks stability, the incentive for high-risk trading is always going to persist. So to summarize my perspective, the evidence points overwhelmingly to external macro tightening and Bitcoin's undeniable function as a high-risk, volatile, speculative asset, one that is highly correlated with the tech sector. This high correlation is the strongest signal we have. Until Bitcoin genuinely decouples from traditional risk-off sentiment, its valuation will be determined by the global liquidity conditions set by central banks. The recent $1.2 trillion contraction is the inevitable result of this macro tightening, forcing capital to consolidate into safer harbors.
And while I would concur that external shocks are the necessary triggers, they certainly open the door to volatility. The severity and the sheer speed of the decline are entirely due to internal weaknesses. The market structure, defined by excessive leverage, dangerously low structural liquidity, and the resulting liquidation cascades, it all acts as a massive multiplier. This structural fragility transforms what should be a routine market correction into a system-threatening panic, proving that the market's internal mechanics accelerate the pain far, far beyond what external macro forces alone would warrant.
A structural weakness exposed by an external economic reality.
And an external signal amplified into a crisis by self-imposed structural vulnerabilities.
Indeed.
This entire episode illuminates that navigating the crypto market requires understanding not only the powerful, inescapable external pressures that govern global finance, but also the internal, self-inflicted wounds that make this asset class so uniquely susceptible to dramatic and rapid valuation loss.